Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, in our past episodes, we've talked about how ULIPs help you build a corpus and strengthen your financial portfolio. We've even discussed about how the newly launched ULIPs or low-cost ULIPs compare with mutual funds and learnt about ways to intelligently go about buying them. Now, since the past couple of months, ULIPs have been back in the news for various reasons, including IRDAI's draft guidelines around ULIP investments, and LIC also launching its maiden ULIP after 2 long years. Then, of course, the recent stock market crash is likely to increase the uncertainties around investing in ULIPs. Today, we'll be discussing about some of these developments in detail and understand its potential impact on our investments. Yashish, welcome to the show. To talk about ULIPs. Yashish, of course, is the co-founder of Policy Bazaar and also its CEO. Yashish, now, tell our viewers what ULIPs are. Once again, like a 101.
You could be investing in government securities, or you could be investing in the stocks, stock markets. Whenever you invest through a mutual fund or through any government securities, you get something called units. And whenever you have a policy which is linked to a unit, it is called a unit-linked insurance plan, which is what a ULIP is. These units can be the stock market. And I just want to take 1 second to kind of explain this. The stock market in 1979 was at 100 points. That is about 36 years ago. Today, whether it's crashed, whether it's gone up, it's at 26,000 points, 27,000 points. Like when you compare it to 100 points, it's about 260 to 300 times higher than where it was. Exactly 8 years ago, 7 years ago, the stock market was at 8,000 points. About 15 years ago, the stock market was 3,000 points. About 25 years ago, the stock market was at about 1,000 points. So the stock market keeps going up at a certain rate, which is about 10 to 15% per year on average. You got to take out all the blips and all. And long-term investors benefit by being in the stocks markets. Right? On the other hand, you have debt investments, government securities, money markets. These are fairly stable sort of returns. Over the last 5 to 7 years, these would have given you between 8.5% to 11% every year. Just to explain, that's higher than the FDs, and it is tax-free. While, I just realized I paid my taxes yesterday. So I just realized that you have to pay taxes on your FD. There was some interest from FD, and I had to pay taxes on that.
That's huge.
That is.
I was hit yesterday as
well. So you eventually get only about 6% from the FD, even on tax-saving FDs, right? Even on tax-saving FDs. So whereas these plans can give you 8% plus without taxes. So ULIPs can be both debt-based and market-linked. So there's this perception that they have to be market-linked. They don't have to be market-linked. They can be debt-based. They can be government security-based. So you just need to decide which ULIP is, more to your liking. And ULIPs are a very cost-efficient and a tax-efficient way of investing.
So what about LIC now? LIC is the largest insurance player.
Yeah.
And recently it relaunched the Endowment Plus plan.
Yes.
And it had withdrawn, I mean, for the benefit of our viewers, it had withdrawn from the ULIPs, launching new products for the last 2 years.
Yes.
And now that it has re-entered this segment, do you think it'll add an impetus to the ULIP market?
I think the trust level that the consumer has in the name LIC is extremely high. So clearly, until LIC does something, it does not have the support of a lot of insurance customers out there who would like to deal with LIC. We get a lot of these queries all the time. I want the LIC product. And if the LIC product is there, clearly there is a big chunk of customers who prefer that. So ULIP as a category, which we have on this show at least 20 times said, and just to clarify to the consumer, ULIP has one of the lowest payouts for distributors. So typically a ULIP today will pay maybe between 0 to 15% maximum, whereas the traditional product will pay at least double of that, if not much more, right? So for the ULIP not to be there as a category, which is a very, very consumer-friendly product with LIC, was like a hole in the market. And it's very good that LIC has filled that hole by kind of plugged that hole by having the ULIP product there. Of course, it was going to be a difficult one because it does have its challenges. But for the consumer, I think it's a great move. And it gives the ULIP category a certain salience and a certain confidence, if you would.
Right. Now, the IRDAI, the insurance regulator, has recently come up with a draft. I want to stress on that, a draft guideline saying that 25% of the funds of a ULIP need to be invested in government security. So how do you read that? Is it going to restrict the kind of returns that people might get in an otherwise complete equity kind of an investment?
One doesn't know. One doesn't know. See,
is it something to get worried about? I guess that's what my question is.
When somebody is investing, I think it's not something to get worried about. The last thing that the IRDA would want is that the consumers do not get their full returns. And the government does require, see, insurance is one of the mechanisms of, if a customer is investing for 35 years, that is one of the mechanisms to invest in long-term projects, government infrastructure business. And that's what insurance funds are used for. If all of them get invested into just the stock market, then somewhere the government's purpose of social development through insurance starts getting hurt. And also for the consumer, most of these projects which are government run would give a return of anywhere upwards of 8%, 8.5%. They've been giving consistently for the last 7, 8 years. So the consumer does not really get hurt. In fact, it provides some kind of a cushion, some kind of a protection to the consumer.
Stability.
Yes. Ideally, see, we would like that businesses have their way all the time. But I think the regulator has to play its part also. And the regulator has to play its part in balancing business, consumers, government, social obligations, etc. So I think on the whole, the regulator has done a prudent task by putting the 25% requirement in government securities. An investor can choose which security. So a government security is everything out there, including an LIC is a government security. So, you can invest in any government security.
Right. Now, we saw the stock market suddenly falling 1,600 odd points. It crashed. The dollar has, strengthened against the rupee.
Yeah.
Unit-linked plans to a considerable degree are, their value depends upon the equity market, the share market. Of course, you told us that it has consistently gone up in the last, 40 years. How would you see this crash? I mean, is it a good time for people to invest right now? Or, I mean, how would you view it?
I will explain in a very simple way. I think it's a good time to invest across the country right now. But I'll explain in a very simple way. In 1986, my father bought a house in Noida that was about 4 lakh rupees. Prices went down sometimes, prices went up sometimes. But selling the house was not easy. Today the house might be worth 6-8 crores, about 6 crores, 150 times. If in 1986 he had invested in the Bombay Stock Exchange, he would have also made about 150 times money. So equity has the potential of giving the same return as the real estate market in the best of times. But the reason we don't get the same returns, or we don't have so many customers getting the same returns, is because we jump out every time there's a dip. And that's the worst time to get out. The worst time to get out of the equity market is when there is a dip. Because that's when there's some form of panic, some form of negativity. See, and the second part, I'm not saying ULIP is for those people who do day trading. If you do day trading and in the morning you invested hoping that the stock market will go up today, and by lunchtime it had crashed by, 6%, you're in a lot of soup. You're most likely going to lose your margin money, etc. Right? But this is not for day traders. This is not even for annual traders. This is not even for people who want to make a return in 2 years, 3 years. The ULIP is for people who want to invest for at least 5 to 7 years, minimum. Minimum. Before that, you go into mutual funds. But if you want to invest for more than 5 to 7 years, then you show me a period in time in history in India when the stock markets have not given a 10% return over a 7-year period, 10% per year. So every 7 years, the stock market has doubled. You show me a period in the last 35 years when that has not happened, including the worst of times.
So a lot of people say that, ULIPs are actually for those who have a higher risk profile. And even in the forms, you know, sometimes you find that written.
I think that's,
do you agree with that?
That's good for awareness, but see, I'm just thinking from a practical perspective. I'm taking the worst of times, 2008, when the stock market crashed from 20,000 to 8,000, right? 2008, that's what happened. Well, the stock market exactly 6 years ago was at 3,000. From 6,000 to 8,000 is not such a bad thing. So it's not for the daily. Do not get worried by the daily stuff. Invest in it and just sleep tight for a period of more than 5 to 7 years. Your returns will definitely be there. The risk is they may be 10%, they may be 17%, but they will be higher than the 8% you get from the FDs.
So what's your checklist for our viewers about the kind of ULIP plans that they should buy?
I think one should determine how long a period you're investing for. There are some customers, let's be practical. There is 50 lakh crore rupees invested in mutual funds every year by Indian consumers. Not 50 lakh, 50,000 crore rupees. There is 20 lakh crore which is held in fixed deposits, right? So clearly the country as a whole likes the fixed return concept. So if you are one of those people who, like me, like to invest in fixed deposits, because I have a 1-2 year time frame usually, maybe because there are costs coming up, and maybe a 5-year time frame, but you want FD return, then you go for the government security based or the debt based ULIP, where the underlying asset is government securities, which have historically been giving 8.5% return. The best part is you will get this return tax free. You don't have to pay the 30% tax that you have to pay on the FD, right? If you have a longer time frame, if you have a 10-year plus time frame, so you are 30-35 years old, you are trying to save for for your retirement period, then you go for the market linked. Please don't go for any debt linked plan. I can promise you 99.99% probability, and I can statistically prove it to you by looking at past data, the chances are you're going to make more than 10-12% return. And definitely go for that additional return and tax free. That additional return is worth a lot, right? In addition, you also get life cover. In addition, you also get sometimes some features like waiver of premium, family income benefit. All these, the biggest benefit of a ULIP is, suppose you see that markets are going to tank. Suppose you get this feeling the next 6 months markets are going to tank. Just move your funds from equity to debt. It is cost free. If you do that in the mutual fund area, you will have to enter one mutual fund, exit one mutual fund. There's time delay, there is cost, etc., etc., entry load, exit load, whatever. Out here, there's nothing. You just switch from one fund to the other. And you can do as many switches as you want. Most ULIPs will allow you 2 switches a year, 50 switches a year, between 2 to 52 switches a year.
So what you're saying is that there's enough of flexibility.
There's enough flexibility.
The choices can be made by the consumer himself or herself.
Absolutely. After 5 years, you can stop the plan. You can top up the plan. You can do partial withdrawals. There's lots of advantages.
Right.
There's better return. There is insurance, both on the debt side and this thing. You've got, your flexibility. You've got lots of things going for the ULIP. So I would clearly advise that to consumers on both sides.
Yashish is going to be answering your questions. We've got Sulabh, 27 years old, and he says his wife is expecting, and both of them are covered under a group health insurance plans that offers coverage for maternity expenses. He would like to know whether they can claim benefits from both the companies, and number 2, should they consider opting for individual health policy as well for meeting future requirements. Yashish.
And no, they can cover benefits from one plan, from one family, because clearly they would need to submit bills in original, and you cannot submit the same bill in original at 2 places. They should please look at which of their plans has got higher limitations. So see, mostly there's a 25,000 rupee coverage for normal delivery and 35,000 rupees for cesarean, or it may go up to 50,000 rupees in some cases. You should look at which of your plans has a higher coverage and then go for that particular plan, or opt for that particular plan to pay for the coverage. You would not be able to use both.
Right, we've got Shantanu, who's 33 years old. His family, wife and child is covered under his company's group health insurance policy for 4 lakhs. Now, he intends to enhance his health insurance cover and would like to know whether he should be opting for individual health insurance plans or a top-up plan. And he asks what are the things that he should be aware of while considering a top-up plan if he takes that.
Yeah. So at his age, where, you know, both the adults are below 50 and the child is still young, I would advise a overall group cover or a family floater cover. But I would advise a top up here because the first 4 lakhs is covered by your company. So why would you want to incur additional cost of the first 4 lakhs of coverage? And 4 lakhs is quite a significant coverage. So I would suggest you to take maybe a top up and of more than 4 lakhs and maybe take one all the way up to 20-25 lakhs so that you're protected from any form of disease or any form of inflation that may happen in the future. Additionally, you should go for a top-up plan which is called a super top-up. Now, what these super top-up plans do is, in case at any stage you retire or your spouse retires and your company plan stops working, so you realize that what would happen is that the day you retire, the first 4 lakhs of coverage is not available. So that means if you go into hospital, you would pay for the first 4 lakhs and then your top-up plan would keep paying because that is there. But a super top-up at that stage at retirement will also start covering the first 4 lakhs. Of course, the cost will go up, but that will start covering the first 4 lakhs. And I think that will be very advantageous to you in those days, simply because by that time some disease can set in, etc., etc. And you don't need to go for special medicals to get that first 4 lakh rupees of cover. So I would say go for a super top-up plan. 4 lakh rupee as the excess, and maybe a 20-25 lakh rupee at the upper limit, and with lifelong renewability and with the ability to take the first 4 lakhs on retirement.
Right, Yashish, we've got Surbhi, and she asks her husband recently underwent a major critical illness treatment, a heart surgery, she says, and the insurance took care of all the medical expenses. However, they now intend to switch to another insurer for better coverage. They would like to know your views on this, whether it's a feasible thing to do.
Very, very difficult. I would advise not, because obviously once a disease happens, your probability of making future claims has gone up. I'm assuming that the plan you have is probably from a government organization, and you believe that if you move to a private organization, you may get a higher level of service. You may believe so, and that may well be true, but most companies would not take you on once they know there is a higher than normal probability of claim. So it totally makes sense to stay with your current plan. Should you wish to take a chance and try out portability, do try that, but do not leave your current plan till the portability is fully approved, and do not be upset if it does not get approved. You've taken a chance, it has not worked. There's probably a 30% chance you'll get one. Try it out. If it does not happen, do not feel offended or bad. We get a lot of these, you know, stinky mails that we tried portability, did not happen, you guys are really bad people. The thing is, it sometimes doesn't happen, and that's not in our hands, but you can try it out. There's about 30% chance you might get one.
Thanks, Yashish. Thanks for answering those questions, important ones at that. But last week we asked you a question: who is the chairman of the IRDAI? And the correct answer is Shri T.S. Vijayan, and the winner is Anirudh Sharma. Now, this week's question is: what does ULIP stand for? You can send in your entries to queries@policybazaar.com. And thanks a lot once again, Yashish.
Thank you.
And we'll see you next time with another episode of Policy Bazaar. Goodbye.